Great.
There you go.
Yeah, let's do it.
Yeah.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family see you on Main Street. We're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode is with the CIO of an insurance company responsible for more than $300 billion in assets and has a major focus on private markets. Lincoln Financial EVP and CIO Jayson Bronchetti and I sat down recently at Lincoln Financial's headquarters in Radnor, Pennsylvania, to discuss the increasing involvement of insurance companies in private markets. Jayson, who is a member of Lincoln Financial's Senior Management Committee and serves as the primary investment officer to Lincoln's board of directors on all investment-related matters, is responsible for more than $300 billion in assets across the general account portfolio and the separate account mutual fund complex. He's the chairman of the board of directors of the Lincoln Variable Insurance Product Trust family of over 100 mutual funds. And he's also on the board of the Lincoln Financial Foundation. Fresh off recent partnerships with Bain Capital and Partners Group on private markets investment products and Bain Capital taking a stake in Lincoln's business, Jayson and I had a fascinating conversation about how insurance companies can approach private markets and how they can build unique and differentiated partnerships with asset managers. We discussed the evolving role of insurance companies as LPs in private markets, why asset and liability matching is a critical framework for allocating to private markets, how the general account of an insurance company creates interesting opportunities for strategic relationships and partnerships with alternative asset managers, the benefit of having a business that works with financial advisors and individuals, the importance of educating wholesalers about private markets, and why insurance wholesalers might have an advantage in educating advisors and clients about private markets products and strategies. Thanks, Jayson, for coming on the show to share your wisdom and expertise about private markets and insurance.
We're going mainstream.
This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream. Jayson, welcome to the Alt Goes Mainstream podcast.
Thanks for having me. It's good to be here.
It's good to be here, although as a Commanders fan, I can't believe I'm in a place called Lincoln Financial.
We won't hold that against you.
Man, I still may have to hold against you what happened this past in the playoffs. But we'll get past that because there's a lot of really interesting things to talk about when it comes to the intersection of private markets, insurance, and the wealth channel. But first, I want to start with your background.
Sure.
You have, I think, a fascinating perspective on both the insurance world as well as private markets, given where you started. So let's start there.
Yeah. So I guess, first of all, I started my career actually in the private markets. So my role when I first started at an investment bank, raising money for middle market companies in America to make acquisitions or to fund any kind of corporate expenses, things that they were doing, strategic initiatives, building of sports stadiums, worked on build out a model to figure out the cash flows for some of the big sports stadiums that we have here today and turn that into something that we could finance in the private markets. And so I got to see the value that private markets kind of can bring to the economy. But I think even more importantly, for this conversation and where I am today, the investors in those deals that we were structuring were largely insurance companies or other institutional investors. So I've kind of been around the insurance and private market ecosystem my whole career.
What were insurance companies doing in private markets then, and how does that contrast with what they're doing today?
There's a lot of similarities, honestly. I think some of the packaging is different, and it's certainly evolved. And I think when you look back, 25 years ago, private markets were always a component for the insurance companies. Insurance companies are great for the private markets because we have well-defined liabilities. We think about things through an asset liability management lens, and we're trying to achieve the best excess returns that we can relative to the risk and capital that we have to hold. So they've always been apart. Historically, it was more kind of syndicated, more through, investment grade private placements being the primary place in which that came to fruition. We also did a little bit of private equity investing, but not systematically and in the way that we do it today. So they've evolved in such that the private markets are bigger. So if I look back, 25 years ago, the number of private companies today is actually much larger than it would have been, back when I started. So there's more private company opportunities. And there's also more public companies, private companies that are choosing to finance themselves in the private markets, whether that be for an infrastructure project or any number of things. And I think post the great financial crisis, it really cracked open the opportunity set for insurance companies and really all investors for that matter to access the private market. So I'd say a lot of things are similar, but it's evolved in terms of really a step function in terms of the amount of activity and volume that's there for insurers to participate in.
How much of that is GPs and asset managers realizing that they can really partner with insurers versus insurers thinking about how they want to make sure they match asset and liabilities and duration and invest in private markets because that's a way to do that?
First of all, it's a symbiotic relationship for sure. And there's forces on both sides that I think are bringing these together, which is creating a nice secular push for the opportunity set. It's hard to say which is, I think, more impactful, but I do think that from an insurance company perspective, like I said, we run things through an asset liability management framework. We have very well-defined liabilities. We have teams of brilliant actuaries that are thinking about what our liability profiles look like. And when you have such good specificity and understanding of your liability profile, it really enables you to invest more in the private market. So there's always been a natural thrust in doing more in the private markets. I think that the alts managers have really come to realize that it's not just about the private equity side. So private equity has always been a nice little niche for us. But for Lincoln, for example, we have about $4 billion in private equity. But our general account right now is about $120 billion. And over half of that is in private strategies, many of which are more credit oriented. And so I think that the alts managers have woken to the fact that, wow, these liabilities are a steady stream of cash flow. And insurance companies can be a provider or an investor in multiple different avenues. So we can participate in the equity deals, but we can also be a full stack capital provider up and down. And that's the thing that I think has really caught the attention of the private equity, of the GPs for that matter. And that's really kind of unlocked a big space for us.
When you say that piece, what you just said, my mind goes to a lot of the things that Apollo CEO Mark Rowan has said about, if you think about private markets, I'm paraphrasing some of the things that he's saying, but it's really about a spectrum of liquidity and illiquidity and how much risk do you want to take on when and where. Mm-hmm. And I think what you're saying kind of really gets to the heart of that, right? You have a ton of strategies focused on private markets, maybe private credit. You might decide to do private credit instead of investment grade fixed income. Mm-hmm. So I'd love to unpack all of that a little bit, where you think about and how you think about liquidity and illiquidity, risk, and how to think about that asset liability matching and then duration associated with that.
I guess maybe starting with the concept of liquidity or illiquidity and how we think about that. I mean, I think back over my career, there's an importance of understanding kind of, is that liquidity there if you need it? When is liquidity real and when isn't it? And that's one of the things, during the financial crisis, I was overseeing a portfolio of public bonds and private bonds. And whether you needed to get funding on a private asset or a public asset, you couldn't get liquidity on much of anything at that time, nor may you want to. You couldn't get a good bid on the high quality rated public bond at a level at which you want to sell. But importantly, did you want to sell? And I think that's the more important thing around liquidity and illiquidity, It's not so much even about the underlying asset and liquidity or illiquidity or the perception of liquidity. It's, in my mind, it's more about the liability that you as an investor have and the liquidity constraints or objectives that you have. And so back to this point on asset liability management for an insurance company, we look at everything through that lens. When are we potentially going to need to, pay out cash flows? And if that time period is quite long, that's a great opportunity for something like private equity. Yes, it's illiquid, but we don't need the liquidity for some time. And so we think about it that way. Maybe it's for a shorter dated liability, like a fixed indexed annuity or something with a 6-year duration. Well, we can do the math and work with these great actuaries we have to figure out, well, how much liquidity will we need and when will we need it? And then we can match up an asset that fits really, really well with that. And I think that actually translates well to any investors. When I think about, we talk to high net worth investors, traditional retail investors, whoever it is, it's all about thinking about the liquidity through your own objectives and constraints that you have. If we're here and you're going to buy a home or something, you're going to need that money liquid. You can't invest in long term, but if it's for retirement, if it's for other things, you can afford that illiquidity and take that on and achieve higher returns in the process.
I think that's such an important point, because what you're getting at is really this kind of different way of thinking about public versus private. It's not necessarily public or private.
Totally.
It's about, how do you think about the liquidity that you need and when do you need it?
Yeah.
And how much do you need?
I think also the point on risk, to go there a little bit, I think about the private markets aren't one big monolithic asset class. And, less liquid doesn't necessarily mean more risk. I mean, risk premia comes in all different forms and fashions, and there's the liquidity risk that we talked about. And to me, that's more about your liability structure. The risk of an asset, however, could be based on a number of different things. And I've seen assets in the private side that I would say are considerably less risky than some of the assets we see on the public side, and vice versa. You really have to do the work to understand the assets that you're investing in, regardless of where you're looking at them.
So speaking of doing the work, how do you think about diligencing private markets managers? What do you look for?
There's a number of things. First and foremost, you've got to look at the performance and the track record. When we look at private market managers, just like any manager, public, private, et cetera, to your point, it's kind of a broad spectrum. They have to be best in class, and it has to be proved out through time. We want to look at folks that have good downside protection, are focused and true to the actual returns of the investment, as opposed to just, gathering assets. And I would say, given the proliferation of things in the private markets, I think it's that much more important now to be focused on finding those managers that have that true edge, and they have an exhibited edge over a longer period of time and through cycles to see how that performs. That's, to me, like the performance is absolutely key.
Performance is a derivative to some extent of edge, right? In the sense that their edge is what creates the performance. That's one of my favorite questions to ask a manager is, what is your edge? Yeah. How do you go about determining what a manager's edge is?
Ooh, that's a good question. I think in each one, it's obviously different. That's by definition, the edge is going to be different by manager. And I think it's just through deep due diligence. You have to get close to the managers and really understand the decisions that they've made. I mean, if we ask someone what they think their edge is, you're going to get an answer, but it really comes down to the due diligence. I think about our alts team, Alex Goins and Pat Dooley, those guys do a fantastic job of really getting under the covers and asking the right questions and then proving it out at a deal-specific level and a performance track record over time. And only then do you really, you're really able to understand what the true edge is.
So as you think about working with different types of private markets managers, you mentioned that it's really about performance. Sometimes it's not just all about asset gathering, but you have a very large general account, 120 billion, like you say, and you're responsible for over $300 billion of assets. How do you balance managing the need to put dollars to work at size and scale with finding the right managers, which sometimes in certain categories might be more niche, might not be able to handle as much capital just because of the function of their fund size?
Yeah, it's a great question. And the reality is, to your point, we have to find investors who can maintain their edge and or source at the scale that works for us. So we, to your point, $120 billion in general account assets, we're putting out big dollars for our own general account. And in addition to that, we're looking for partnerships that we can scale and even build things together that can go bigger and farther in that regard. So I do think scale and the ability to continue to maintain performance at scale. And that's actually one of the things that probably unique for an insurance company or someone of our size, that we spend a lot of time on understanding what their ability is to put money to work at scale. What's their sourcing edge? A lot of times it isn't just about, like maybe a public strategy where you're able to pick and choose readily available securities. This is about, do you have the relationships and the boots on the ground to go in and structure things and get access to CEOs and CFOs and really be a part of that. So it's a huge part of the way we look at things.
I think where my mind goes when you talk about that, boots on the ground, you think about certain strategies. Scale can be beneficial. So things like private credit, infrastructure as examples, maybe relative to lower mid-market private equity as another example. You also mentioned a bit earlier that private markets is not just private equity. It could be things like private credit. How do you think about the evolution of alternative asset managers, how they've grown as businesses, and how that relates to how you then think about partnering with firms in private markets?
We sit in a unique space as an insurance company because, one, we have the ability to partner with a lot of folks in terms of what we need to accomplish. We also have the ability and access to channels of retirees and the wealth channel where we can be effective to them. And I think as I look at kind of the intersection of the traditional alts managers and the insurance companies, I think there's a tremendous amount of value that can be created. Again, there's this symbiotic relationship. And I think that the asset managers have, clearly awoken to that reality over the last several years. And they're building out their businesses to have platforms that can support, both returns and that on the equity side, for example, and also the breadth of solutions on the credit side. I think that when we think about it, you want to make sure that it isn't just someone who's doing private credit off the side of their desk. If you're a private equity company and you're getting into private credit, that may be great if you're really committed to it and you understand the risk premia and the relevant elements of running a private credit strategy, and you're committed to having the boots on the ground and sourcing and hiring professionals with deep credit backgrounds. I don't think that those things need to be mutually exclusive. So I do think you can have a really solid private equity firm and private credit firm at the same time. That being said, I don't think that there are many managers who are wonderful at every possible thing. And that's one of the things about our platform that I feel really privileged to be a part of, is that we run a multi-manager platform. So we work with some of the best and brightest alts managers and traditional managers all across the globe. And we're very purposeful about who we partner with on which strategies. And there are certainly some that have the capabilities where we can go, deeper and broader. And so we have some good partnerships there. And we have some where their focus is very specific. And it doesn't mean that we don't want to work with them. We absolutely do. We're trying to find the right manager in the right categories. And there are some where we can win through multiple channels. And we'll try to do that.
You bring up an interesting point, which is you have the ability to work with different types of managers in different types of ways. You have a general account. You have the ability to create and manufacture products and distribute that to the wealth channel. You have your own distribution channel as well, which is really unique when, I think, through the lens of an alts manager, that they can work with you in a bunch of different ways. I want to unpack that a little bit because it's interesting to think about how you as a firm can approach private markets, and you can approach it in so many different ways. So walk us through how you think about the different ways in which you can employ private market strategies or build or partner with funds, and how you do that across the different channels that you have.
This is something that we're really excited about. And maybe just to take a step back, because this was kind of a strategic question that we asked ourselves. When Ellen Cooper, our CEO, formerly our CIO before she was promoted and I took her role, and our CFO, Chris Nezapor, also comes from an investment background. They were both at Goldman Sachs and I came from JP Morgan. And then the rest of our senior leadership team, including John Kennedy, who leads our phenomenal distribution franchise, came together and started to think about, okay, what are some of the unique elements that Lincoln has to bring to bear just generally as a company? And we immediately went to, well, we've got this unique multi-manager platform, right? We have the best and brightest. We can access them. Another thing, we have incredible distribution. I mean, we have John's team, Lincoln Financial Distributors, and we have over 500 wholesalers who are out in every possible channel in the wealth categories. So whether it be, RIAs or the broker-dealers, independents, huge platform, army of folks that are out there, have built relationships over decades and are incredibly sophisticated in their ability to communicate around complex strategies within an individual investor's portfolio. So we've got 60,000 financial professionals that they work with day in and day out, providing them with the training that they need around complicated products that, in solutions that we sell and administer. We also have a retirement plan platform under Jimmy Reed where we're out talking and putting things into retirement plans. And so we look at that and you say, okay, you've got this incredible access to asset managers. You've got this phenomenal distribution. And then in addition to that, we have a product manufacturing capability, first of all, around funds. So we're used to building funds for an end retail consumer, either high net worth or everyday consumers. And so we got together and started thinking, okay, what can we do here? What's the secret sauce? And the secret sauce for us was, well, we can leverage this general account asset that we have where we are going to invest and get the best possible returns within the products that we offer, the insurance products, annuity products, et cetera. But we can also, we're in this unique spot where we have asset management partners who are phenomenal at what they do, but maybe they don't have access to the wealth channel, or maybe they aren't as adept or have the experience in building retail-oriented fund structures. So we put that together, and that's one of the reasons why we just recently announced, as you know, partnerships with Bain Capital, as well as with Partners Group. And so we saw those as real win-win opportunities, and the partners felt the same way.
Unpack that a little bit. Why would Bain and Partners Group want to partner with you? And what do you bring that they didn't have where you can help them with their business?
Yeah. Well, first of all, they're both phenomenal firms. So I'm sure they can build and do honestly anything they choose. They're both just tremendous firms. That being said, I think the biggest thing that we bring to bear for them on the distribution side is it takes a long time to build those relationships in the wealth channel. I think about John and his team. We have the training infrastructure. We have the relationships. We have the home office relationships. And we have, candidly, just the trust that's been built. Lincoln is known for being a provider of the financial protection, security, and objectives of our 17 million customers and their families. And so we have that today. We have that trust, and we take it very seriously. The company's been around for 120 years, and we've been building these relationships for decades. And so I think when you look at a firm like Partners Group or Bain, they look at us and say, wow, it could take us a long time to replicate something like that. That's what Lincoln's good at. We can find this kind of symbiotic relationship whereby we bring that together, we co-manufacture a product using some of our views on what might be best in different channels and our infrastructure there. And then beyond that, we have the general account that we can win in multiple different ways.
When I hear you say that, my mind kind of goes to that you're Apollo as a service. In a sense, if you think about it, right?
Yeah,
like
it's an interesting way to put it.
Apollo manufactures their own distribution through captively owning Athene, the insurance business, right? And there are obviously differences between your business and Apollo's business. But to your point, not every alternative asset manager is going to be able to or have the capabilities to own an insurance business themselves. That's a trend that we're seeing happening, but it seems like in a sense you're a partner to these firms and can do that in a way because you have the distribution through your wholesaler channels.
Absolutely.
To be able to do a lot of what they do through manufacturing it internally.
Yeah, I mean, Apollo as a service is an interesting way to say it. I think it's more even just about building those partnerships together, because I think when we put these products together, we're in it together for the win. I think about Bain, for example, an even deeper strategic relationship that we're developing with them puts us together. We can get the best of Bain and the best of Lincoln and bring that together, but it doesn't preclude us from working with Partners Group or working with Goldman or others. And that's what we try to do, is find out. We think we have a lot of really unique advantages as a company, but we know we need partners as well. And I think that as this ecosystem evolves from, like, we used to have alts that were available to institutional investors like a Lincoln or others, I think over the next decade, and you've covered this incredibly well, better than most, as the democratization of alts continues, there are going to be multiple ways to win. There are going to be multiple partnerships. And I think the secular tailwinds just around the growth in terms of alts getting into the wealth channel and getting into insurance products is kind of the third one. And so there are all these different ways to win. I think you're going to see lots of partnerships, and I think we're in a really good spot to take advantage of that.
I think you bringing this up in a really elegant way, but it's not just the intersection of private markets and wealth, which is such an interesting trend, but it's, you have the third layer to this, which is adding the insurance component to it. I want to unpack that in a few different ways. So one is just starting with the general account. and then getting to the wholesaler side and distribution of private markets products that you either partner or manufacture on.
Yeah.
But with the general account, how do you approach private markets? Because you can probably think about private markets in different ways.
Sure.
You can, I don't want to say be more experimental. That's probably not the right word or fair word for it, because you're being very discerning about what managers you work with. But you can really think creatively about partnering with firms, given that it's the general account.
Yeah.
How do you go about that?
So, I mean, first and foremost, we have our obligation to be good stewards of the capital that we invest on behalf of the general account, and we take that very seriously. We look at everything, like I said, through the asset liability management lens. We think about our solvency ratios and making sure that we have really a fantastic balance sheet and it's well bolstered. And so, first and foremost, that's our obligation with those assets. But to your point, we run a lot of different types of products. So we, short dated annuities, we have longer dated life policies, we have retirement products, any number of different things. And so that gives us degrees of freedom in terms of the types of assets that we can explore in different areas, as well as our own surplus. So Lincoln's capital that sits behind there. And that does create some ability to perhaps be a little bit more creative in terms of what we're looking at. But we're very careful. We look at everything through a risk lens. But when I think about the strategies, for example, that we're launching with Bain and Partners Group, these are fairly straightforward strategies from our perspective. Right? We've been investing in private credit for decades, and we've been investing in royalties for decades. But we found the two managers, and we've invested with them in these strategies for a number of years. We found two managers that we think are absolutely best in class at what they're doing, and we're taking that to the market. So even something like royalties, which perhaps to you and me and other institutional investors, royalties have been around forever. Well, that's true, but to the retail consumer, they may feel new and different. And so I think that's almost a good example of something that we incubate to some degree, maybe as a way to think about that, but we're thoughtful about what we put forward. And so when we thought about, for example, those two strategies, we worked with our distribution partners, John Kennedy, and at the end of the day, the consumers and the advisors that their team partners with, to say, what would your customers find interesting? And the focus was distributable yield types of strategies. That would be a great place to start. So we went back kind of into the lab with each of them and said, hey, let's build a strategy that works really well for our general account, work on the customizing of the investment management agreement, and then work with our fund structuring area to design funds that enable our end customers to get the actual value that's embedded in those strategies. Because it doesn't do any good for us to take, for example, an illiquid strategy and put it in a very liquid wrapper. In order to do that, you're going to eat up a lot of the return value. And so we're very purposeful in designing funds that were evergreen funds, interval funds in one case, tender offer funds in another, but to make sure that we got the best investment opportunity that was proven, tried and true, and we'd invested in it. We're going to eat our own cooking, put our name behind it as well, but do it in a way that is accessible and is in the right wrapper. So back to this liquidity point, you can't put less liquid things in liquid. I mean, there are complications there. You can, but you're going to eat it up in fees. So we want it to be really efficient and able to offer that into the retail consumer.
I want to touch on those two things that you just mentioned. One is the liquidity piece of this and matching the right wrapper with the right product. And two, using the general account to then seed or test out a strategy to some extent before bringing it broader to the retail channel or to the wholesaler channel. How often are those things kind of done in tandem, where you're working with the other parts of the business as you're thinking about investing in and allocating to private markets managers, and also then creating and structuring products? I imagine there's a lot of knowledge wrapped in what you're doing internally to create and structure the right products that you then realize will be the right fits for the wealth channel more broadly.
So I love the question. And what I would say, kudos to Ellen and Deshaun Woodruff, our Chief Human Resource Officer. He's a bigger title than that, but for lack of a better term, we really focus on one Lincoln. That's been something that has been, since Ellen took over as CEO, it's been, hey, we're one Lincoln. We need to think about it that way. Sure, each part of the organization has its own set of specific objectives and fiduciary responsibilities and stakeholders. But at the end of the day, I think that value within a company like ours comes from, finding those opportunities in the seams and thinking about them. So we talked about Alex Goins, who leads our alts program. Look, first and foremost, he wants to put up the best alts returns he can, has done a fantastic job with his team in doing that. But there's a part in his mind that is always thinking about, oh, how do I think about where this could possibly go? Build the relationship with our distribution folks, with Ben Richer on our fund side who's structuring. So we are constantly, there's like, I don't know a great way to say it, but you're always focused on you're laser focused on your own area, but you have to be looking laterally to find those opportunities. And it's not always the case that you have something that works really well for the general account that's also going to work well for distribution. And that's part of the process as well. We may have some great strategies on the alt side, but they're not something that we think we can put into the right vehicle or the right structure that will be effective or purpose built. And that's where we spend a lot of time kind of thinking about that, because that part is absolutely critical.
I'd love to double click on that point, because I think there's an element of product innovation that's happening in the wealth channel, which to some extent is good. You need to understand what the customer wants. And I think a lot in the wealth channel, I think they want things like some level of liquidity. That's why we've seen the advent of evergreen structures.
Yeah.
There's pros and cons to that, and people are giving up certain things by not doing a closed-end fund, but they're gaining other things by doing an evergreen structure. Where do you think that line is between product innovation and putting square pegs in round holes where there's too much trying to solve for the need for the end client, where you're abstracting away some of the reasons why private markets exist in the form and fashion that it might?
Well, I think you have to have healthy tension between the different areas such that everyone is clear-eyed about the objectives of the stakeholders for whom they're responsible. And I do think there's a risk of that. I mean, anytime you see, I love the private markets, I think there's a ton of value, I think there's a tremendous amount of upside, but anytime you see the amount of growth that we've seen, I think you're going to run into situations like that where things aren't, it's a square peg, round hole. And I think you need to be mindful of that. That can be an interesting short-term objective for someone, but in the long term, that's not going to work out. I mean, when things go from the perception of less risky to then all of a sudden risky, or perception of liquid to then all of a sudden illiquid, that's where you run into problems. So I think it's a risk. I think it's something that we're very mindful of here. I hope that the rest of the industry, and a lot of great people out there that are focused on that, but you cannot lose sight of that. It is absolutely a risk.
Do you think the fact that you have permanent or relatively permanent capital, as well as long duration with many of the accounts that you have or types of capital that you have or the objectives you have behind that capital, has that helped you think about how you'd structure evergreen products or the different types of products you'd structure in different ways because of who you are as a firm?
I absolutely do. So I didn't have this appreciation before working in an insurance company, but the actuaries are so important and they're so brilliant, and we're fortunate to have all of them. And they bring a discipline to the way that we structure just about anything that we invest in for our products, right? So we have specific strategic asset allocations for every product that we run. So whether that's a 5-year, MYGA, multi-year guaranteed annuity, whether it's a registered index-linked annuity, whether it's a very long-dated VUL policy, or any number of things, the actuaries kind of keep us sharp in that. So we may think, well, as an investor, you're thinking about, you have all these degrees of freedom, you can do anything you want. I mean, that may be the bias that a typical investor comes in with. I think that because we are, first and foremost, we're making promises to our customers at the end of the day, and we need to make sure that we're there to stand up and deliver the type of security, protection, and growth for our customers and their families at the end of the day. So that brings a discipline around portfolio construction, not only within the general account and the products we sell, but we bring that discipline into the way that we think about designing products for the end customer. So I absolutely think it's been a big part of it. And if you see the people who are involved within Lincoln in developing things that will go to the retail consumer, that is what we're focused on. And so we realize this. We've been in the business for 120 years. We've been a long time. I mean, Abraham Lincoln, we take a lot of value, pride in the namesake, and that honesty, integrity, and being there for the long term. There's no shortcuts. And so we need to be very purposeful and build things in a way that works.
What do you think is the most impactful or biggest thing you've learned having been an asset allocator from an insurance perspective as you think about investing? Is there something sitting in this seat that has changed your perspective on investing that you didn't have before?
Honestly, I think it's around this concept of asset liability management. I don't know that the traditional investor, and certainly any kind of a retail investor, thinks about things through that lens. And I almost think, nobody talked about it externally until, the regional banking issues that came about, where you had, regional banks that were borrowing very short and investing very long. I mean, that trade works until it doesn't. And having this focus on good, disciplined asset liability management and really respecting the rigor of scenario testing, what could go wrong? And that's something that we spent a tremendous amount of time on. And I don't think I spent the amount of time that we previously in prior roles thinking through and running stochastic scenarios around what could happen, running deterministic scenarios around any number of things, but always doing so through that asset liability lens. I think that's one of the things that's been most impressed upon me over the last decade here.
On that point as well, and extending it to the distribution team that you have, do you think that they have a different appreciation for private markets and the concept of asset liability matching because of the broader firm that they're a part of, as opposed to just being part of a distribution team that doesn't have an insurance component to it?
Yeah, I think they may. And I think the other piece of that is they're used to working in an environment where, we manufacture complicated solutions. And our wholesaling force is very adept at understanding those at a level in which they can become true experts in the structure of the products, the design of the features, and have the ability to educate financial advisors, help financial advisors educate their end customers, and really think about it in this long dated way. We have built out it's really, John Kennedy and Tim Seifert, who oversees all of our training and education, they spend a tremendous amount of time making sure that our wholesalers understand the products at a very, very deep level. And we're bringing that discipline and rigor from the annuity products and the life insurance products, the retirement products, bringing that into the alternative private market investment strategies, where we have, take them through a long, very specific and tailored education process. So I think not only do they have an appreciation for it, but we will make sure that they have an appreciation for this. They're engaged, they're energized, they want to be a part of this, and that they can articulate it in a way that everyone feels good about what it is they're offering.
On that point, because I think we're in a period where educating not just the end client, but educating the distribution professional is so important in terms of getting private markets to the next phase. What has been most effective in educating the team of wholesalers that you have about private markets?
So I think the most effective thing is not one thing, but it's the collection of the things that we're doing. So the way that we did, just give you a little sense of the way to kind of unpack our training around this. And, credit to Tim Seifert and Amber Williams and her team who lead different pieces of this. But we said, okay, let's design a program whereby we need to contextualize the market, the private markets. What does it mean? Who are the players? What is the value proposition of various different parts of the private markets? That's kind of step one. Step two, let's educate them on what's out there. Step three, let's educate them on the different types of structures. So we have very purposely built modules to go through, okay, this is how an evergreen structure works. This is how it's different from a BDC. This is how it's different than a REIT. This is different from a mutual fund. We take them through that level. Then we do modules on each of the different strategies. So private equity, private credit, subsets of each of those, asset-based finance, royalties, whatever the case may be. And we take them through all of these steps. After that, that's a mix of in-person as well as online kind of group education. Then each of those wholesalers needs to practice and present back to a team of experts to show that they do truly understand it. And I know John is very strict about making sure that before his people are out talking to anyone, they need to understand it, as well as my team does. They need to know it as well as the investors. And so we have a team, we call it Client Investment Strategies, that has been for about 10 years now, sitting embedded with distribution. They're investment experts, and they're used to talking about that. And then the last thing we do, we train them on the specific strategies, and we get out into the field with Bain, with Partners Group, et cetera.
On that point as well, if you think about, just to put it in context, I think you said you have around 500 wholesalers or so. Just to put that in context, many of these private markets managers, Blackstone I think has 600 people focused on the wealth channel, 300 people on the distribution side. Apollo, KKR, Carlyle, Blue Owl, they have 100 plus, 200 plus size sales forces. Not that many firms have the types of boots on the ground that you have.
Yeah, and I think it's not just about the boots on the ground, which is huge, obviously, but it's the relationships, it's the connectivity, it's the home office relationships that we've built, and it's the understanding of how to engage with those customers, meet them where they want to be met, provide them with the training and education that fits for them. So we take, for example, the training module that I took you through, then we can offer that out to customers and tailor it in a way that meets each of their needs. So it's this whole ecosystem, which I personally, 10 years ago before joining Lincoln, I probably didn't have anywhere near the appreciation for it. When you go ride along with a wholesaler and you're in a financial advisor's office and you do that and you get the feel for that, you realize how powerful and differentiated that is.
Speaking of powerful, you said something else that resonated, which was many of these wholesalers are already selling complex products.
Absolutely.
Those products are annuities, other types of insurance-linked securities. Those are not easy to understand and probably not easy to sell.
Yep.
How much do you think that plays a role in your distribution teams, the firm's distribution team's ability to both understand and then work with advisors in private markets? And are those advisors more attuned to private markets because they've already gone through the work of doing something similar in the distribution of insurance products?
Yeah, this is absolutely like the hidden gem in all this, right? To sell an annuity product, a registered index-linked annuity where you're offering kind of essentially puts and calls and different, you really need to know your stuff. And you really need to be able to articulate a complex thing in a very simple way that's transparent and understandable. And our wholesalers are phenomenal at this. Like I said, ride along with them, see what it's like. I'm just blown away at how sharp they are and their ability to do that. I think it's an absolute win. And that's where we're going to start, is with some of those folks who've had really good success in understanding the most complicated products. They have these now that they can offer alts as well. And candidly, I think that the alts are a simpler product. The private markets strategies oftentimes are a simpler product. It sounds different, but they can be a much simpler product. So I think that our wholesalers are going to be phenomenal at this. And I think to the point about engaging with advisors who may have varying degrees of familiarity with private markets or sophisticated, complicated products, I think the good news is because we go into all these different channels and we kind of know, given the years of experience we have, what's relevant in which channels, we can tailor the education, we can tailor the assistance we provide, we can tailor the menu, the things that we're providing to them to help them meet them where they want to be met, as opposed to necessarily just kind of forcing a product on them.
On that point, I think you also have a really interesting perspective because you have the allocator's perspective. You're manufacturing products or co-manufacturing products with firms that are sub-advising those products and strategies. And then you can also go out in the field and talk with your distribution team and the wholesalers, speak with financial advisors. What do you think has been the thing that's resonated most with you when you think about what financial advisors are taking in when they're thinking about private markets or how they approach it? Is there something that's really hit you as like, oh, wow, this is really interesting in terms of how they look at private markets?
I think with some of the folks that we talk to, there's been kind of a mystique around private markets. And it's something that I maybe have taken for granted, having been in the private markets for a long time. It's like we said earlier, public-private markets, all kind of this big pool of things that we can invest in. But I think that the structures and the history of the private market and alternative landscape has been such that those assets have been elsewhere. They've been in institutional portfolios. And that when you go and talk to, and I remember having a conversation with some of our wholesalers about a deal that we invested in, a music royalties deal. And it's, hey, pull out your Spotify, pull out your phone, let's look at your Spotify, go through it. What songs do you have and that? And we were able to show them ones where we actually had purchased, the music royalty rights on those. And so every time you play that, we're getting a return on that.
You play it in the office
Yeah,
too?
exactly. Yeah, just keep playing it, right? But things like that, and you realize, and there's this kind of aha moment of like, there are all these things in the real economy that we do day in and day out that aren't translated simply into an investment opportunity for those advisors or wholesalers, advisors, or their end clients. And I think that's been the interesting thing, is when you see that like aha moment of like, oh wow, I totally get this. This isn't as complicated as I thought it would be, and now we are able to democratize alternative. I know that term gets used a lot, but it's true. I mean, the ability to bring that in, and then the light bulb moment for these advisors, I think, either is or will be the realization of just how beneficial this can be for their clients. Institutions have had the benefit of this diversification, the benefit of these additional returns, and if packaged in the right way, this is now going to be accessible. And it's a great way to engage their clients and build those client relationships.
What's interesting about what you just said is feels like you're sitting in the middle and straddling both the institutional mindset and framework as well as the individual mindset and framework when you think about private markets, and you're kind of sitting in the middle between both of those things.
I'm energized by it. I think it's really exciting. I think the other thing that we haven't really even talked about is there's those things. There's the institutional side, which makes, I think, the value and the engagement that we have with alts managers and how we manage on that basis. There's that wealth side. Then there's also the insurance and retirement products that we offer. So, I mean, it's well documented, the retirement, crisis that's looming, or just the fact that people don't have pensions the way they used to. We have a whole retirement plan platform. We have insurance products that are designed, life products that have very long lives to them. We have the ability to go a step further and think about how do we put some of these alternative investment products within also insurance, retirement, and other products that we sell today. So there's multiple ways to win, and we kind of hit in each of those three pockets.
On that last point on creating products in the retirement space to help people have income when they hit retirement, what does that look like in terms of product structure, and how would private markets strategies fit into that?
Well, I think we're early days on that. I think it's going to take some time. There's a tremendous amount of regulatory, infrastructure that sits within the retirement landscape as well. There should be. I mean, we need to be responsible in the way that we're thinking about retirees. But I do think at the end of the day, it's going to need to look and feel to some degree the way that a mutual fund looks and feels in terms of the delivery of that. And that's why one of the things we like about the evergreen type of funds that we have is that you can have them structured in such a way that it has kind of the look and feel and the administrative ability of a mutual fund, or we can put them in a CIT as another type of structure that fits really neatly. So I think it's going to look and feel ultimately the way that retirees are used to seeing the investments in their portfolios. I think that's going to be really important. I don't know exactly what that looks like at the end of the day. I know there's obviously a tremendous amount of energy going into that as an industry. And what I'll say is I don't know where it's going to go, but if I look 5 or certainly 10 years from now, I think that private markets are going to be a big piece of retirees' portfolios.
What do you think needs to happen? Is this a matter of there needs to be more track record on many evergreen funds and strategies from firms? Sure, Partners Group is actually a good example in juxtaposition to that. They've been doing this for over 20 years, but many evergreen strategies are just getting going. So is it a matter of there just needs to be longer track records to see how these funds behave and how the assets interact with people maybe needing to take some liquidity at certain times, or the valuation methods around that? Or is it something more around technology and the ability to kind of structure things in a different way?
I think it's a bit of both. I think there's going to be a fair amount of education that needs to take place, first and foremost, so that the industry has a good understanding, and then that the end customers have an understanding of what's meant by that. And I think we're all collectively across the entire ecosystem working on that. And so that's one piece of it. I think technology is absolutely going to accelerate and enable that. When I think about just even the ability to put alternative strategies into structures that will work at the end of the day, that in and of itself is a technology, so to speak, and thinking about the right documentation and structuring and able to do that. But to then be able to do that at scale in a systematic way, at the scale that I think is necessary to serve the retirement market in a meaningful way, there has to be a technology angle. And I know you've covered well, talked to some of the folks that are leaders in that, folks that we speak to, and think that's going to be a big piece of it at the end of the day.
I think one thing that you talked about is there's different ways in which you can create product structures. Mm-hmm. I want to talk about product innovation.
Okay.
What do you see as some of the product innovation that's going to come up? There's obviously, you're partnering with firms like Bain and Partners Group. There's model portfolios out there. There's ways to put private markets and insurance products or CITs, as you mentioned. What are some of the next frontiers of product innovation in your mind as it comes to private markets?
I think that the private markets and insurance products is already happening in a meaningful way, but I think that's going to be a big frontier. I think that's going to break open a lot of interesting things, because I think that insurance products by design have a longer duration to them, or that they're so well suited for alternative or private market assets. I think that's going to be the frontier. I think the wealth channel, absolutely, that's at the forefront. It's a huge market. And so I think that's what's attractive, is that total addressable market for manufacturers, asset managers, et cetera, to get into that. And I think that will come, and that's the focus. But I also think that the insurance products will be a big piece.
And When you say insurance products, including private markets strategies, are there specific strategies you think will be embedded into insurance products more than others?
Well, I think it comes back full circle to the asset liability management point, right? I think if it's a long duration life insurance product, you're more inclined to have things like a private equity strategy or an infrastructure strategy, something that has that type of duration to it. I think when they're thinking about shorter dated products, that's going to be a good place for asset-based finance or some of the asset-based security types of transactions that they used to get done more on bank balance sheets that are now finding their way into the private markets. So I think it's going to be very specific to the liability profile of the product.
So you don't need to say if you were included in this survey or not, but Goldman recently did their annual insurance survey of CIOs and CFOs. I think it was collectively around 14 trillion of AUM represented in 416 or so insurance CIOs, CFOs. A lot of them said private credit is an area they want to spend more time on. A, what are your thoughts on that? And B, whether or not you participated in the survey, which that remains anonymous. But what, from your perspective, is most interesting as you think about allocating to private markets right now?
So first of all, Goldman Sachs is a great partner of ours, GSAM specifically, and so of course we participate in their survey. They're a fantastic firm, and we partner with in multiple ways. And I'm not surprised, or wasn't surprised to see private credit being a big focus. I think though that the interesting thing in private credit is that private credit isn't a monolithic asset class, right? Private credit, the thing that I'm most excited about are some of the investment grade strategies that we're seeing now, things that used to get, like I said, financed in the bank market, by changes in regulatory environment and capital, et cetera, have found their way into what I would say are the more patient hands of an insurance company. So I look at private credit as those investment grade opportunities and things that historically weren't available in the kind of quantum that I think will be available. And so we're very excited by the fact that asset managers are building those strategies, bringing them to us. And so I think it's within private credit, more investment grade, asset-based type strategies.
Pull the string out on that, because it feels like my head goes to the slide that Apollo had in one of their investor day presentations around like anything on a bank balance sheet is private credit or an area that we can focus on. I think $40 trillion market. It's encroaching on bank balance sheets to some extent. How do you think this all plays out over time?
Well, I think this is a healthy transition of assets into the patient hands of investors that are liability aware and have the right pockets of money in which to invest those. I think it's a great trajectory. I think there are ways that everyone can win in this. I think that the growth of the capital markets, be it public or private, a lot of belief and faith in over time, the longevity and return potential of being a capital market participant. And I think there are going to be players that are asset managers, alternative asset managers are going to play a role, asset allocators like Lincoln, the banks are going to play a role. And I think everyone is kind of figuring out their role today. I think there are going to be different, degrees of kind of winners and losers. And I think anytime you see a big proliferation in any asset class, there are going to be the occasional bad actors or things are going to be problematic. And so that could be a problem for the markets. But I think secularly, the tone and the tenor is so positive in terms of where we're headed and getting things evolved into the right capital pools over time, and the roles that each of those institutions can play will be formed in time. I think there's going to be a lot of winners.
Well, you have a really interesting perspective on this because you've worked in private credit for a long time. Like you said before, joining Lincoln, you were in private credit. You've been at banks. From your perspective, what are some of the biggest risks that are posed to private credit, and what worries you most about private credit right now, given the growth in the asset class or the category itself?
The number of firms that have come into private credit and making sure that people really understand the profiles of what they're investing in. I think oftentimes, if I look back in history, you get into trouble when something's it's a credit risk masquerading as illiquidity risk. I think we've seen some of that kind of come across our desks where, it's a private credit deal, and then you peel back the onion and it's a private credit deal, but there's a whole lot of other risks here beyond just the fact that it's a less liquid strategy. I think that wouldn't be surprised if there are some of those situations that create some bumps. And so that's why I think it's really important to be focused on working with managers that know the space, aren't purely asset gathering, and can manage through and stay true to their underwriting.
We talked about the risk on the other side. What excites you most about private markets right now?
Wow, I'm always excited about private markets, as you can tell. I think that the fact that we have the possibility of bringing that to a broader audience, to me, that is truly, when I think about like the heritage of Lincoln, and we talk about, we want to help our customers, your tomorrow is our priority. And I look at private markets as something that can help deliver on your tomorrow. And if we can bring that out into a broader audience, I think it's just going to be fantastic as a win-win, both for the health of the economy and the growth of the private markets, but also for the returns of those customers.
I think that's such a great way to wrap up this conversation, because I think private markets, there's a ton of promise. I think what we'll see tomorrow is probably even more exciting than what we'll see today.
Absolutely.
So,
well, thank you for having us.
Thanks
It's been great.
so much, Jayson. This was a ton of fun.
Likewise.
Yes. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going